Larry, how are you looking at the risk of doing too much versus doing too little, and what investors really need to keep in mind, given the fact that the Fed is walking such a tightrope at this point?
I mean, that's the reason why we think there's going to be a mild recession. We do think the Fed probably went too much. I know a lot of people have talked about the fact that this economy isn't as interest rate sensitive as it once was. I disagree. I think the fact that we all had excess savings that we could spend what we needed to do travel, to buy goods, that's why it wasn't as interest rate sensitive. But now that those excess savings are pretty much gone by our measurements, I think interest rates do have a big impact. And you're already starting to see that happen.
Larry, we've also been watching the wild moves in the bond market, the 10-year yield sliding from recent highs, now at its lowest level since early August. What's your read on what we've been seeing in the fixed income space?
I like fixed income here. I actually think it's the fourth time this year that the market may be wrong-footed. And what I mean by that is that when you came into this year, we were optimistic on the equity markets, but most people were not. And look what's happened with the equity market and tech in particular. In March, people didn't really want to be in the financials because of what was happening, the turmoil in that industry. And financials are up 10% from those levels. In June, people thought energy prices were going to continue to go lower. They didn't. They reversed. I think now is a time period where everybody thinks that rates are going to stay higher for longer. I actually think that those rates are going to go lower, and that's going to set up a good market for bond investors.
What does that timeline look like, Larry?
I think for the next 12 months, we think interest rates could go down to around 3.25% to 3.5%. And if you think for the 10-year, that is the 10-year Treasury yield. And when you look at that type of movement, you're talking about the potential for high single, even potentially close to double-digit returns in the bond market. So I think that's a pretty good risk-adjusted return for bond investors.
So when you consider that, what does that portfolio mix look like for you?
Well, when we look at our portfolio, we're more balanced right now. You know, when you look at the equity markets, we think that there's a potential, at least here in the short term, to have a pullback. But again, we don't really try to necessarily time the market. And remember that you tend to get 3 to 4, 5% pullbacks in a given year for the equity market. And we've only had one so far year to date. But longer term, we think the S&P 500 can move up to 4,600 by, this time next year. I think bonds will do well. So we continue to preach a more balanced approach to portfolios at these levels.